Ever feel like investing is this super complex world you're just not invited to? Well, you're in the right place. It can feel totally overwhelming, I get it. But today we're going to break down 5 simple, time-tested strategies to turn all that confusion into real confidence.
So why does this all matter so much? Well, let's start with this number right here, 77%. What is that? That's the percentage of U.S. adults who have financial regrets. I mean, that is a huge number. It basically tells us that feeling like you could have done something different with your money is an almost universal human experience.
And what's the single biggest regret for nearly a quarter of those people? You're looking at it, not starting to save for retirement soon enough. It's the kind of regret that really only gets bigger over time, which makes getting started today so incredibly important. So our whole goal here is to help you turn that really common anxiety into clear, confident action. We're going to give you the tools to help make sure you don't share that same regret down the line.
Okay, so how do we do that? Let's start with 2 of the most popular and frankly straightforward strategies out there. Think of these as the foundation you build your entire financial house on. They're simple, they're powerful, and they are perfect for beginners. First up is buy and hold. The name pretty much says it all, right? You buy an investment and you hold on to it for the long term. The big idea here is to think like a business owner, not a gambler. You're not trying to guess these wild short-term price swings. You're betting on the long-term success of great companies. It's like planting a tree and just giving it years and years to grow. The beauty of this is its simplicity. You're not glued to your screen all day, stressing out. But the biggest risk here? It's not in the market, it's in your own head. The hardest part by far is having the patience and the stomach to hold on when the market inevitably gets choppy. You have to fight that urge to panic sell. All right, our second foundational strategy is buying index funds. If picking individual companies sounds, well, kind of daunting, this is for you. An index fund basically lets you buy a tiny little piece of every company in a major market index, like the S&P 500. This gives you what's called instant diversification, which is just a fancy way of saying don't put all your eggs in one basket. You own a little of everything, so you spread out your risk.
You know, this famous quote from Vanguard founder Jack Bogle just captures the idea perfectly. Why spend all your energy trying to find that one tiny needle when you can just buy the entire haystack? That is the simple, powerful philosophy of index fund investing. This approach is just incredibly simple, and it gives you that lower risk diversification right off the bat. But here's the kicker. Historically, just earning the average market return has actually beaten most professional money managers over the long run. So, yeah, you won't own the one superstar stock that goes to the moon, but you also won't get totally wiped out by picking a loser. Okay, so those are 2 awesome, core kind of set it and forget it strategies. But what if you want to be a little more hands-on with your portfolio? Let's look at how you can do that while still playing it smart. Right, let's talk about customizing your portfolio. These next 2 strategies let you add a bit of a personal touch to your investments, all while keeping a safe and steady core.
This one is called the index and a few strategy. It's a hybrid approach, and honestly, it can be the best of both worlds. You keep the vast majority of your money, your core, in a safe, diversified index fund, but you carve out a small slice to invest in a few individual companies you've researched and really truly believe in.
This whole approach has a built-in safety net. Look, even if your individual stock picks totally bomb, they only affect a tiny little fraction of your portfolio. The vast majority, that 94%, is still safely growing with the overall market.
So this strategy lets you get your feet wet with stock picking without taking on a massive amount of risk. The challenge, of course, is that you do have to properly research those individual companies. If you don't, you're not investing, you're just gambling. All right, another approach is income investing. Now, this one shifts the focus a little bit. It's not just about growth. It's about generating a steady stream of cash. You invest in companies or bonds that pay you regular dividends or interest. And dividends? They're basically a share of a company's profits that they pay out to you, the shareholder. You can then use that cash as income or, and this is powerful, reinvest it to buy even more. The big advantage is that regular cash flow, which, let's be honest, can feel really secure. But there are some unique risks here. A company can always decide to cut its dividend, and when that happens, the stock price usually falls too. You also have to keep an eye on things like inflation and, of course, taxes on that income. So far, we've covered what to buy, but our 5th and final strategy is all about how you buy.
This is such a powerful method because it focuses on consistency, which can be just as important as the specific things you choose to invest in. This is called dollar cost averaging, and I love this one. Think of it like a subscription service for your portfolio. You simply invest a fixed amount of money on a regular schedule, say $100 every single month, no matter what the market is doing. It's automated, and it takes all the emotion and all the guesswork right out of the equation.
And it's as simple as 1, 2, 3. You set your amount, you pick your schedule, weekly, monthly, whatever works, and then you automate it. Seriously, automation is the key here because it forces that discipline and consistency that really builds wealth over the long haul. So the magic of this approach is that you automatically buy more shares when prices are low and you buy fewer shares when prices are high. For example, let's say you invest $100 when a share costs $10. You get 10 shares. But if the price drops to $5, your next $100 gets you 20 shares. So now you have 30 shares for $200, making your average cost just $6.67 per share. The trade-off is you won't invest everything on the single best day, but since predicting that is literally impossible, this is a winning strategy for most of us. Okay, so there you have it. 5 powerful strategies. Now, let's bring this all home and talk about how you can turn this knowledge into immediate action. But before you jump in, a quick reality check. First, make sure you have your emergency savings sorted out. Seriously, investing is for long-term goals, not for cash you might need next month. And remember, you absolutely do not need a fortune to start. Most modern brokers let you begin with pretty much any amount.
So here it is, your game plan, boiled down to 3 simple steps. 1, secure your finances with that emergency fund. 2, open an account with a reputable online broker. And 3, pick one of the strategies we talked about today, start small, and set up that automation.
We started this whole conversation with the single biggest financial regret people have: not starting early enough. So the only question left is this: knowing what you know now, what will your first step be to make sure that isn't your story?